Okay, well, again, thank you all for attending. Welcome to our seminar this evening on the power of saving. My name is Shannon Dwyer, and I am the Director of Digital Services at Dutch Point Credit Union, and I will be your host for the seminar this evening. So again, welcome. We're really looking forward to sharing this information with you. Savings is a super important topic, and you've got to learn ways to maximize your financial future, and savings can do that for you. So a lot of good information about to come. We do have one quick housekeeping note. We have enabled a chat and a Q&A feature on this webinar for you to ask any questions that you may have along the way. We'll do our best to answer your questions at the conclusion of the presentation, but if for some reason we're unable to get to them, we will certainly follow up with you after the presentation is completed. Okay, so with all that said, give me a moment and let's get to it. I'm going to stop that video and share my screen with you. And we'll get our slideshow started. So the power of savings, tips to maximize your financial future. So our seminar objectives this evening, we are going to talk about what savings can do for you, how to save automatically, saving for the unexpected, emergencies, that sort of thing, saving for retirement. Then we'll cover saving and budgeting and how important budgeting is in your savings process. Then we're going to talk about making your pledge to save. And then, of course, we'll follow up with any questions at the end. Now, many of you may be doing some of the things that we'll cover today, but most people haven't mastered all of them. So the goal of this seminar is to give you the tools to plan and manage your savings effectively. So we're going to start off today by reviewing some United States savings statistics. First of all, 38 million US households live paycheck to paycheck. Unfortunately, this means these households spend everything they earn, leaving no room for savings. 28% of adults have no savings set aside for emergencies or unexpected expenses. And 50% of adults cannot cover an unexpected expense of $500 or less. One of the topics we'll discuss later in the seminar is saving for that unexpected time. Adults 35 and under have a personal savings rate of -2%. For this age group, between the high student loan debt and stalled wages and earnings, saving anything at all has been nearly impossible. 36% of adults have not started saving for retirement. Retirement savings is vital. Social Security payments are expected to decrease in coming years. And unfortunately, that means money in savings will be necessary to live a comfortable retirement. So the sooner you can start saving for retirement, the better. And for the adults who are saving, they are stacking away an average of 7.9% of their annual income. Now, this is actually higher than in previous years, which is great. And that's when Americans were only saving an average of 4.4% of their annual income. So it's great to see that more is being saved. Trust me, every bit helps. So what is saving? Saving is money put aside for future use. It's reducing your expenses and paying yourself first. Savings is a critical part of a stable financial outlook. But savings also gets treated sometimes as an afterthought. So that's why we're here today, to make savings a top priority in your financial wellness. We'll be covering tips so that you can map out your savings to achieve your savings goals. So let's talk for a minute about what savings can do for you. Savings can protect you from emergencies. With an emergency savings fund, you can always be prepared for the unexpected. Savings can help you pay for education, whether it's for yourself or for one of your family members. And we all know that the cost of school and all that comes along with it just keeps increasing every year. Savings can assist in pursuing those dreams for further education. It can help you pay for major life events, like getting married, having a baby, and more. Savings can also assist you in purchasing big ticket items. A good example is buying a car. With the rising cost of car prices, having a good sized down payment can help you keep your loan needs lower and potentially provide you with a more favorable interest rate on your loan. Savings can help you accumulate wealth. Saving for retirement is critical, so you can enjoy life after your working days are over. And finally, savings can position you for financial freedom. Saving the right way means that you will have less of a need to take on debt, you'll be well positioned for future needs, and you'll have confidence in your finances as you continue through life. Now, there are so many ways to save responsibly. So which one is right for you? We're going to talk about some of them today. And the first one we will cover is saving automatically. Saving automatically is by far the easiest and most effective way to save. Automatic savings simply means you have a process in place to save at regular intervals, whether that's monthly, weekly, or even daily. It's an easy to understand concept. Basically, you set up funds from sources like your paycheck or maybe your checking account to be automatically deposited into a savings account. This accomplishes the set it and forget it model. You set up these automated transfers ahead of time and let your money do the work for you. Saving automatically can work for any savings goal you have, including saving for an emergency fund, home ownership, education, vacation, or even holiday shopping. And the best part about saving automatically is that you don't have to make it a huge amount. You can start with only a small amount, and you can save on a schedule that works for you. Over time, those deposits will add up. Even a small amount of savings can be a big help in the future. As we mentioned, there are a number of ways to save automatically. So let's cover a few in more detail. All right, first is split to save. This is when you have a portion of your direct deposit go straight to a savings account. This one is super easy here at Dutch Point, since we do the work for you. First, you'll want to make sure your direct deposit is coming into your account. Then all you have to do is give us a call, text us, or visit a branch and let us know how much you want to direct to your savings account. We can get this going for you by your next pay cycle. So it's a quick and easy way to start saving. Next up is automatic transfers. This is a great method for folks who want to be in control of their transfers and deposits on their own. Log in to digital banking and navigate to the transfers area. Choose where you want your money to come from and where you want it to go. as well as the amount to transfer. Then choose a day of the month or a regular interval, such as every 2 weeks, to transfer a set amount into your savings account. Click submit, and you're on your way to automatic savings. Then there's the loose change method. So every day, put all of the loose change in your pocket or purse into a jar and don't spend it. You can watch your savings literally pile up in there. If the jar starts to look tempting, resist the urge. Roll up your coins and deposit them into your savings account. Over time, your automatic deposits will add up. Just think, saving $50 per month adds up to $600 in 1 year and $3,000 in 5 years. Plus, you'll earn interest on your savings when you keep it at the credit union. Saving automatically can help you in many ways, but one way it really pays off is to help you save for the unexpected, which is our next topic. So what do car accidents, fires, broken appliances, and layoffs, what do all of those things have in common? They're all unexpected, uncontrollable, and urgent life events that occur in our world every day. What you can control about these situations is the emergency money you save to prevent these situations from having a negative impact on your financial status. An emergency fund is a safety net that can help cover unexpected expenses without breaking your budget or taking on debt. Emergency savings are meant to be kept separate from your other savings goals and only used in case of an emergency. Now, as we reviewed at the beginning of the presentation, 28% of adults have no savings set aside for emergencies. Setting aside cash for unexpected events is important for long-term stability, and it can also give you peace of mind, considering how unexpected life can be. Many people wonder how much they should have in an emergency savings fund. A good rule of thumb that we recommend is to save at least 3 to 6 months of living expenses in an emergency savings fund. The amount of emergency cash you should have depends on your lifestyle, your committed expenses, your household size, and your income. We'll cover a strategy to help determine your individual emergency fund recommendations in just a couple of minutes. So now that we've covered why saving for the unexpected is important, let's talk about some strategies for building up your emergency savings fund. First up is to make savings automatic, a topic, as you know, we've already talked about today. Use that direct deposit to automatically set aside a portion of your paycheck into your savings account each month. It's an easy way to save for emergencies. Next up is to evaluate and reduce monthly expenses. Look at non-essential costs that can be substituted with less expensive or alternatives, or maybe cut out completely. If you tend to buy coffee every morning, try making coffee at home, or wait to drink the coffee at work. Take a look at subscriptions that may be non-essential, or you could try cooking more at home and eating out less. Trust me, Your emergency savings account will thank you later. Another popular strategy people use is to sell used items. Look around in your house. If you haven't used something for, let's say, 6 months, why not sell it? There are free apps and websites that help you sell unwanted items for cash. You could also have a good old-fashioned garage sale. Set aside the money you make into your emergency account. And also, look for additional income. Do you have a talent that could be profitable? Or maybe you have some free time on your hands. Make some extra money by getting a second job. Or help out family, friends, and neighbors by completing odd jobs for cash. Or you could start making and selling items online. So we've covered why having an emergency savings is important, and we've discussed ways to fund your emergency savings. Now let's cover some tips on starting to save for the unexpected. Here's a simple way to figure out how much you need to save each month to reach your emergency savings fund goal. So step 1, calculate your monthly expenses. This includes everything from your rent or a mortgage payment, utilities, car payments, gas, groceries, phone bill, any other necessary payments made on a monthly basis. For this example, we are going to assume $2,000 a month of expenses. Then step 2, choose the number of months you would like this emergency fund to cover. Remember earlier we said it's good to have between 3 and 6 months of savings for an emergency fund. So for this exercise, we're going to use 3 months of savings. Step 3, determine how long it will take to fund your emergency savings account. This number is based on the amount of money you intend to save per month. So for this example, let's say we want to reach our emergency savings goal in 3 years. And step 4, do the math to calculate how much to save per month. So first we multiply our monthly expenses by the number of months the emergency fund will cover. So in our example, $2,000 of monthly expenses multiplied by 3 months of savings that we want to have equals a $6,000 emergency fund needed. Now multiply the number of years you'll save to reach your emergency savings goal by 12 to figure out the number of months you'll need to fund that emergency account. So we want to save our emergency fund in 3 years, and there's 12 months per year. So 3 months times 12 months, 3 years times 12 months per year is 36 months to fund your emergency savings. Finally, divide the total emergency savings goal by the number of months needed to fund it to determine your monthly contribution. In our example, $6,000 of an emergency fund is needed, divided by 36 months is a $167 monthly contribution. So you need to save $167 every month for 3 years to have that $6,000 in the emergency savings. You can use this same calculation with different numbers to find something that works best for you. Now let's move on to another important savings topic, and that's saving for retirement. For many of us, saving for retirement is simply signing up for our employer's 401k, choosing a contribution percentage, and calling it a day. Now, while that's a significant first step to saving for retirement, the truth is a lot of us aren't saving enough for retirement, and certainly not for the actual lifestyle we'd like to live when we reach that stage. So here are some questions to ask yourself when planning for retirement. First, how do I want to live when I retire? This is a question many people don't consider. Putting money into a 401k or other retirement account doesn't necessarily mean that you'll have enough saved when you hit retirement age. So what does retirement mean to you? Are you living in the same home? A smaller home? Are you traveling or happy with living a life of leisure? Are you going to move to a different area? And if so, is the cost of living there higher or lower? There are many factors to consider when you retire. By thinking about these things now, you'll be better equipped to retire on your own terms. Next, am I contributing enough? Now that you've given thought to how you want to live in your retirement years, the question is, are you saving enough? To accurately plan, figure out how much you've already contributed towards your retirement. Pick what age you want to retire and how much you want to have saved when you do. Then use the retirement planning calculator on our website to learn how to achieve your savings goal. Finally, you say to yourself, I'm already saving for other things. How can I save for retirement too? I get it. Emergency funds, home ownership, education, other things. How do we do it all? You do what you can with what you've got. However, when trying to prioritize savings, remember this. Retirement is one of the major life milestones that you can't borrow for. Retiring comfortably is a huge gift to your children, your loved ones, and most importantly, yourself. Paying for education or giving some gifts is a nice gesture, but being able to retire and not worry about you is better. Saving for everything you need, both now and in the future, happens best when you budget effectively. Budgeting is essential when creating a savings plan. A budget is your blueprint for your day-to-day finances. Its purpose is to plan, organize, and improve your financial situation. So a budget starts with two key components. The first is income. That's all the money that you have coming in. And the second is expenses. That's all the money that you use to pay your monthly bills and live your life. Creating a budget helps you determine how much you can save, among other things. So let's review why budgeting is so important. A budget helps you do several things. A budget is a roadmap that helps you figure out whether you're going in the direction you want to go financially. It helps you Make informed choices about where your money goes, leading to a more enriched life. It tells you whether you're living within your means, which is when your income is more than your expenses. We always want to live within our means so we aren't spending more than we have coming in. Budgeting helps you meet your savings goals and prepare for emergencies. Without a roadmap for managing your money, you can lose control of your finances, which can lead to unnecessary financial stress. You also may be less likely to achieve your goals. But with a roadmap, you control your financial future. Now, let's review 5 steps you can take to create a successful budget. First, make a list of all of your sources of income. Then, you'll want to determine where your money goes and break down where your money goes into 3 expense categories. The first is fixed expenses. These are expenses that are paid out for the same amount every month. Now, one example is your rent. You know, each month your rent is, say, $1,000. That monthly obligation remains the same month to month, so that is considered a fixed expense. A car loan payment is the same thing, a fixed expense. You know, for example, that you pay $300 each month for your car loan payment. The next category is variable expenses. These are expenses that change on a monthly basis depending on your spending needs. Grocery bills, eating out, and shopping are good examples of variable expenses, since they can and will change. You'll want to get an average amount that you're willing to spend on these variable expenses from month to month so you can plan for them in your budget. And be sure to include a little fun money in your variable expenses. That way you have some money set aside to do the things you enjoy without the worry of being able to afford it. Finally, there are periodic expenses. Now, these occur on a more irregular basis, but you still need to include them in your budget. Car insurance is a good example. You may only pay car insurance every few months, or maybe just twice a year, but it's still an expense you need to budget for because it will always be something you'll have to pay. Now, you'll want to take your total income and subtract all of your expenses from it. Remember that you want to have money left over. Avoid spending more income than you receive. If this calculation results in a negative number, you will need to review your expenses to see where you can make some changes. Continue to review things until you feel comfortable with the budget you put in place for yourself. And continue to manage your system. Double check this budget every couple of months to be sure you're staying on track. Creating a successful budget helps you set smart financial savings goals for yourself because you know how much you have available to save. So, what are SMART goals? SMART financial goals are specific, measurable, attainable, realistic, and timely. Examine each goal you want to achieve and make it SMART. First, make it specific. Ask yourself questions about the goal, like why it's important to you and what do you need to do to achieve it. Next, your goal should be measurable. Saying that you would like to save $1,000 by the summer is a measurable goal because it has a dollar amount and a time frame attached to it. Your goal should always be attainable. Avoid making a goal for yourself you know you can't achieve. You know you want to save $1,000 by the summer, but based on your budget, is that goal attainable? And is it realistic? Or are you setting a goal for yourself that you know you can't achieve? Don't add stress making goals for yourself that are too lofty. You want to be able to achieve your goals, not bring yourself down by not meeting them. Finally, your goals should be timely. If your budget shows that you have the means to save $1,000 by the summer, that end date is timely for you. You want to feel confident in the goals you set for yourself. And that's why following the SMART plan will help you achieve your savings dreams. Now, we've covered a lot today. We've learned a lot about savings, tips to maximize your savings goals. So that now that you know ways to make savings easier, how to start a budget, and how to make SMART goals for yourself, it's time to make the pledge to save. So here are some ways you can make the pledge to save. Set those SMART savings goals. Remember to make sure your goals are specific, measurable, attainable, realistic, and timely. You can commit to a 52-week savings challenge. This is a really cool savings tool, and there are no complicated rules to remember. It goes like this. Week 1, you save $1. Week 2, you save $2. And it continues through the year, adding $1 more to each week's savings goal. By week 52, you'll have $1,326 in your savings account. It's a simple way to make your money grow fast. Set up automatic savings. As we said, let us do the work for you to set aside your savings automatically. Make sure to establish your emergency savings fund. Always be prepared for the unexpected. Develop a budget and stick to it. And finally, control your financial future. Pledging to save puts you in the driver's seat for your financial well-being. Now, Dutch Point has a number of tools to help you reach your savings goals. So we're going to cover a few of those next. Here are a few safe options from Dutch Point for storing your savings funds. First up is special purpose savings accounts. This type of savings account will allow you to access your money easily in case of an emergency. and it offers a competitive dividend rate. It's also a little less tempting to use money in a special purpose savings account because it's not linked to your debit card. Then we have holiday club accounts. These allow you to set aside funds for the holidays. The earlier in the year you begin a holiday club, the more you'll have saved up to spend. Put a little away with each paycheck and avoid those high interest credit cards that can be used with holiday spending. Then we have money market accounts. Now, this type of savings account is appealing because you gain access to higher dividend rates than special purpose savings accounts. Plus, your rate can increase as your balance increases. The more you save, the more you earn. You can enjoy access to funds when you need them because your money stays liquid and available to you. Another option is to invest some of the savings into a certificate as a way to earn interest on money you've already saved and can afford not to access for a while. You'll get a guaranteed rate of return based on your initial deposit and term selected. You may also consider laddering certificates so they mature at different times, giving you access to your money at various intervals. Then we have Save to Win accounts. Now, Save to Win is awesome. It reinvents the way you think about traditional savings products. It's an innovative savings program designed to reward you for saving money. The more you save, the more chances you have to win. Here's how Save to Win works. Request a Save to Win certificate account and make an opening deposit of at least $25. Your initial deposit is your first entry into the monthly prize drawings. Every time you make an additional deposit and your balance increases by $25, you'll earn an entry into the monthly prize drawings. And up to 10 prize entries may be submitted per month. Monthly prizes totaling up to $3,750 will be awarded. And quarterly prize drawings give you the chance to win up to $5,000. But the real prize from Save to Win is the savings account you build with regular deposits. But the monthly and quarterly prize drawings certainly help sweeten the pot and encourage you to save more. With a Save to Win account, you have absolutely nothing to lose and everything to win. And finally, individual retirement accounts, otherwise known as IRAs. Whether retirement is far down the road or just coming around the corner, there's no time like the present to begin securing your future. Individual retirement accounts are designed for you to save consistently over time so you'll be able to enjoy comfortable living in your retirement years. IRAs deliver flexibility, accessibility, and tax advantages that can help you achieve your financial goals. If you're just beginning your career, planning for your growing family, or approaching retirement, it's never too late to start saving. Remember, at every stage of life, your credit union, Dutch Point, is here for you. We are proud to bring you this type of information have these seminars for you to learn things. Savings, as I said at the beginning, is super important. So this is a topic that's very important to us. And we're always here for you to help you through your life. So that will conclude our presentation. Just give me a moment to stop sharing my screen and come back up. I hope you found the information that we covered beneficial to you. At this time, I'm just going to check and see if there are any questions that we have. And it looks like we do have one question. Where can I find more information on the 52-week savings challenge? Great question. It's a great program, and a simple Google search can help you find little charts and stuff like that. And what we're going to do is, after this presentation is over, you'll receive a follow-up email from DutchPoint, again, thanking you for attending the presentation. And we'll have some information about the 52-week savings challenge in there, because it's a really easy way to save a good chunk of money that you can put towards whatever is most important for you. So we'll include that in there. Let's see, give one more question time. Let's see. Oh, yes. How do I open a Save to Win account? Oh, awesome question. You can go online and open it online through our website. You can give us a call or stop into a branch. Like we said, all you need is $25 to start a Save to Win account, and you will be on your way to savings, and you could potentially win some money. So it's a win-win situation for you. And it looks like that's all we have for questions tonight. So I want to thank you again so much for attending. Hope you got a lot of information out of tonight's presentation, and feel free to give us a call, text us, chat with us, stop in a branch to learn more about savings and go over some of the things that we've talked about today. Our account specialists are here and ready, waiting for you to come to us, and we'll be happy to help you. So with that said, I hope you enjoy the rest of your evening. Thank you again for attending, and have a great night. Bye.